Rakesh Arora, MD and Head of Research at Macquarie Capital as well, joins in on board with us. Rakesh, we were just chatting about metals. What's the sense that you're getting about this space? Cyclicals clearly seem to be coming back, becoming the flavor of the month. Do you think more positive Chinese data is only going to aid the move in the metals basket?
Yeah, we are, quite positive on the metal sector. Not just that China is, holding up. It is also because the second largest consumer of commodities is Europe, and that is where positive data started to come out. So clearly, bottoms have been made in Europe, US is doing well, and China holding up. So that solves one part of the equation, which is demand for the commodities. And demand, we are now pretty much certain that has bottomed out, and things are looking up. But there's huge oversupply in the global market for most of these commodities, which is likely to limit the gains on commodity prices per se. And that brings us to, the Indian stocks which are benefiting because of rupee depreciation. Most of these companies are seeing better realization in rupee terms, and bulk of their costs are rupee linked, so their margins are expanding. So I would say Indian metal companies are looking extremely good at this juncture. Some of them have run up quite a bit and taking a pause, but I think one needs to accumulate on any kind of declines.
Okay, I looked at your strategy report, and clearly you have one of the most aggressive price target on the Nifty, 7,200. I read the report twice. You're very bullish for 2014. You expect markets could give a return of what, 15%?
Yeah, it's not too bullish, I would say, because we are assuming a 17-year average for the P multiple at 15 times and assuming around 16% earnings growth, which is not that, great. So I would say that markets have potential to do even better. And if we get a stable government in May, I think probably the P multiple can expand to 16, 17 times also. So it is based on a base case scenario. I think a bull case is even stronger. And remember that, most people who are looking for any kind of earnings growth driven story, they will be a little bit disappointed. But I think it is a PE re-rating which is going to drive the stock market in this year. And so all eyes would be on election results, which would be the key trigger out here.
But Rakesh, PE rating, some would argue, has already happened. In last 2 years, we've hardly seen any earning expansion. In fact, earnings have contracted and market P multiple has only gone up. So some would argue that after 2 years of PE re-rating, can we see another year?
See, earnings have been growing at 11 to 12% in the last 2 years. So it is not to say that earnings have not grown. They've grown much below, the 20% plus growth that the Indian market is used to. And recovery is expected this year to 15-16%, largely driven by exports. So not really driven by the domestic economy still. But, expectation of domestic economy starting to do well post a new government comes in, which is what is going to drive the PE re-rating. And people would start expecting that, FY16 onwards, things would look much more better.
Rakesh, what's the sense that you're getting about mid-caps? Because they up until now have hugely underperformed, barring a few odd days. Does it seem like the strength of the market is going to continue to be concentrated towards the Nifty names?
See, last 4 months, mid-caps are outperformed, large caps are around 15%. So that's a strong outperformance. And on a PER basis, the discount to large caps are narrowed down to a 8-year low. So clearly people are betting on mid-caps in the last 3 to 4 months. However, on price to book, they still look cheap. But our view is that, since earnings growth is likely to disappoint in FY15, it's not likely to be a stellar earnings growth, people will be disappointed in mid-caps. And given the volatility which will happen before the election results, etc., it is better to stick to large caps rather than venture into mid caps. So that's the broad call that we are giving on, large cap versus mid caps.
Your strategy report goes on to say that IT and pharma should be the core part of the portfolio, whereas you expect cyclicals to lead the rally. So if you're making a case that Indian economy will make a comeback, the first port of call should be, get out of commodity, get out of defensives.
Yeah, see, largely what I would say is that the first part of the recovery is being led by exports. So IT and pharma being the main, exports for us, that has to be a core portfolio. But it's difficult to go overweight on IT at this juncture because it's already 21-22% of the MSCI India index, and already it is hitting quite a high limit. So people can't buy more than 10% in any company. So at the max you can be neutral on IT, and that's why that brings us to second question is that if we get a stable government, how do you position yourself? Because clearly, as I was saying, that there would be PE rating and people will be, trying to load on cyclicals. Now, when you look at cyclicals, the quality names, there's a kind of dearth of quality names. You can buy L&T, one name in probably construction. Difficult to find even the second name out there. So that is where the banks come in. They give you, good exposure to the economic growth in domestically, and some of these private banks like Axis Bank, ICICI Bank are also priced pretty attractively. So that is the call here that we get a stable government and cyclicals start to get re-rated even before the things start to turn up in data.
Do you think one should actually wait for the election outcome? Because if the election outcome is favorable, markets would be circuit up. If the outcome is not favorable, markets would be circuit down. We've seen that happen in 2004 and 2009.
Yeah, that is a kind of a event risk which is there in May, and if somebody is very cautious, can actually wait. But see, valuations for these banks are looking extremely attractive. So the downside from here on will not be that great. Meaning you might miss out on 5-7% better buying opportunity if election results are not that great. But from a general perspective, also these stocks are looking attractive. So I wouldn't really wait here and lose 10-15% on the date of elections, and rather buy into them on any kind of weaknesses.
Rakesh, does the NBFC pocket interest you?
Things are bottoming out for the NBFC pack, and what is really worrying is actually what would be the legislation changes which would come in, and that the impact of that on their margins, etc. So and most of these companies are mid-cap companies, so we are actually sticking with the large-cap banks at the moment, and there is value here, but we are in no hurry to really add to these names at this juncture.
You've liked Ranbaxy in the past, but the flow of bad news for Ranbaxy is just not abating. First it was plant 1, then it was plant 2. Now we understand that there is another 483 which has been, which has hit their third plant. Do you think Ranbaxy is a must avoid?
We have been bullish on this name from around 300 rupee level, and at 450 we thought that the risk reward ratio, given the news flow, is turning slightly against us. So we've turned neutral on it. So we're not saying it will sell. It's a neutral for us, and probably at low levels we'll look to buy again. But yeah, we need to figure out what this 483 is and how severe it is. The key triggers which are going to come are the new launches, and which I think they are adequately prepared with alternative sites. So I don't think new launches would be stopped. But after the sharp run up from 300 to 450, I think the stock will consolidate till we get clarity on 483.
Rakesh, you've told me that why do you like NBFC, but the NBFC space could be divided into 2 or 3 parts. Housing finance companies, pure infra plays, and then you've got names like Mahindra and Mahindra Financials and Bajaj Auto Finance, which are quasi banks now. What do you like within that space?
See, we like the CV financing companies better than any of these names, and specifically we have an underperform rating on LIC Housing Finance. So we clearly don't like that company at this juncture. And even in CV financing, as I was saying, that we have enough indications of bottoming out of the sector, but there's no indication in terms of catalyst which can really move the stock upwards. So the big catalyst for them would be interest rate cuts, etc. And given that inflation has moderated a little bit but still remains very high, chances that we don't see interest rate cuts at least for another a few months. So probably the catalyst would still be missing here. So value, but I would say wait before you buy.
Rakesh, you've just talked about no interest rate cut inside, but what about a status quo policy? Is that a given this time around on 28th?
See, the expectation is that there would be no change, right? And that is what we think, because inflation started to come off, and having waited last time, I think the RBI governor would wait to see whether there is any further decline in inflation happening. So I think we are into a status quo situation at least for another 1 or 2 policy meets.
So one contra idea from you is metals, where you're bullish on Tata Steel. Anything else which is a big contra idea where other brokerages or market opinion is leaning one way and you are moving one way?
See, in metals itself, we are extremely positive. So I think most of the names there we like them, like JSW Steel, Jindal Steel and Power, and Fesosellite. These are some of the names that we are confidently pushing. Then we are pushing a negative call on cement for pretty long time, even though some of the participants were extremely bullish. And today we have results of Ultratech Cement, which are not likely to be that great. So we expect earnings downgrade cycle to continue there, and stocks to see much lower levels from where they are. So I think that would be another slightly different call.
I'm slightly confused. Whereas your basic assumption for 2014 is that economy will revive, things will look up, and demand and cyclicals will make a comeback. So if economy revives, the first thing which will revive after banks would be cement.
Well, see, don't confuse between domestic commodities and global commodities. So while most of the global commodities are benefiting from global demand and rupee depreciation, domestic commodity like cement doesn't really benefit. In fact, it is facing a higher coal cost because of rupee depreciation. And secondly, as I've been at pains to explain, that the domestic economy is not really recovering at that pace. It is just the export-led growth that we are seeing at this juncture. So what you will see is PE re-rating in expectation of a domestic recovery post-elections. And that too, you have to buy stocks which are looking attractive. Cement stocks have outperformed for last 2 years and only now started to come under a little bit of pressure. So they are no way value buys or something like that. So you have to be with private banks, as we were discussing, which are looking much better to play a PE re-rating.
Rakesh, good chatting with you. Really appreciate you taking the time out and speaking with us.